Lock the door, turn the volume up, because right now, silver is not one price. Wall Street is telling you $100. Shanghai is whispering 110, 111, 113s, and that whisper is the sound of a market cracking in half. Today we're talking about the $113 silver secret, why Shanghai is paying roughly $10 more than New York, and why that gap is not a cute inefficiency. It's a distress beacon, a physical warning siren, a divorce. If you're watching silver like a normal commodity, you're missing the plot, because what's happening in January 2026 is not a rally, it's a structural stress test, and the paper system is failing it. Here's the thesis in one sentence. The West prices silver with paper promises. The East prices silver with metal in hand. And when those two prices separate by $10, $13 an ounce, the market is telling you which one it trusts. In the next few minutes, we'll break this down in 5 moves. The one price illusion, $100 silver versus the real world. The premium math, how $111, $113 prints in Shanghai. The mechanics, why Shanghai is bidding higher and why arbitrage can't heal it. The plumbing signals, backwardation, inventory drain, and the magnet effect. You open a price feed and you see a single number. That number is comfort. That number is simple. That number is not reality. Because as of late January 2026, silver has crossed the 100 Oz milestone on global screens, but the market is not uniform. In New York and London, you see $99 and $100. In Shanghai's benchmark auctions and local pricing, the metal has been fixing closer to 111 plus when you convert yuan per kilo into dollars per ounce. Let me show you the idea of the conversion, because this is where people get lost. Shanghai often quotes silver in CNY per kilogram. To compare to COMEX, you convert like this: USD Oz, GI, Canterbury, CNY, KG, and FX rate 32.1507. So when traders run that math and they see a print that implies $111, $50, $112, even $113, that's not a rumor. That's the market saying, deliverable metal right now costs more here. And that means something brutally important. The most manufacturing-dense region on Earth is willing to pay a premium for immediate physical access. Not exposure, not paper upside, access. This is the Shanghai Secret. Not because it's hidden, because most people refuse to stare at what it implies. Almost 6 now. Well, not. The premium math is a panic math. People hear $10 premium and they think, so what? Someone will arbitrage it. That's how it works in a normal market. But this premium is different because it is not being created by speculative excitement. It is being created by industrial urgency colliding with policy friction. Imagine a factory manager. He doesn't care about your chart pattern. He cares about a delivery date. He cares about a production line that cannot stop. And if the choice is pay a premium today or shut down the line tomorrow, he pays the premium. That's why I call it panic math. Not emotional panic, operational panic. A calm, ruthless pay-up for continuity. Why Shanghai pays more. The premium exists for one reason. Shanghai is behaving like a physical price signal, not a speculative casino. In the Western system, COMEX and the LBMA ecosystem, the dominant object being traded is a contract, a promise, a paper receipt that can be rolled, netted, rehypothecated, or cash settled. Most participants never want delivery. They want exposure. They want a bet. They want liquidity. In the Chinese system, especially the SGE and the SHFE delivery culture, the end goal is closer to metal that can be used, bars that can be moved, inventory that can be counted, ounces that can be welded into the future. So when stress hits, the West can keep trading silver even when real silver is tight. The East can't, because factories do not run on contracts. They run on atoms. Now add the driver everybody keeps underestimating. China manufactures roughly 80% of the world's solar panels. Silver isn't a luxury input there. It's a conductor, a paste, a bottleneck. Add EV systems, power electronics, AI data centers, and semiconductor packaging, and silver starts behaving like industrial oxygen. You don't notice oxygen until it's missing. Then you'll pay anything. Now layer in the policy catalyst, export controls. On January 1st, 2026, China implemented a new licensing system for silver exports, effectively ring-fencing supply. Here's what that does mechanically. Normally, a big premium invites arbitrage. Buy cheaper in the West, ship to the East, sell higher, close the gap. That's how markets heal. But a licensing gate is a broken bridge. It slows flows, adds uncertainty, and can outright block the usual routes. So the premium doesn't close. It persists. And when it persists long enough, it changes behavior. Buyers stop waiting for normalization and start pre-ordering scarcity. That's why Shanghai's price isn't just higher. It's shouting, deliverable silver is scarce where it matters. Markets don't break on social media. They break in inventories, spreads, and delivery behavior. A. The magnet effect. Metal flying east. When Shanghai is paying 10 pluses more, that premium acts like a magnet. It pulls bars out of wherever they can be sourced. London, New York, anywhere that still has inventory willing to move. And the story traders keep repeating is simple. Metal is flowing east, not because people are bullish, but because the bid for physical is urgent. Picture the scene. A pallet of bars, seals checked twice, paperwork stamped, a logistics manager who doesn't smile. A shipment that's treated like medical oxygen, because in a tight market, the most valuable thing is not a contract. It's a bar that clears and arrives, and once that flow starts, it becomes reflexive. Lower visible stocks in the West create more fear, which increases demand for physical, which drains stocks further. That's how a normal price move turns into a logistical scramble. B. Backwardation, the now premium. Then there's backwardation. Normally, futures trade above spot because you're paying for time, storage, financing. Backwardation flips that. Spot becomes more expensive than the future. In plain language, the market is paying extra to get the metal now. Not next month, not after a roll, now. And backwardation is not just a weird curve. It's a confession. Immediate delivery has value that paper cannot replicate. C. The paper defense, margins as a lever. Now, what does the paper system do when the physical system refuses to calm down? It tightens the leash. In stress conditions, exchanges can hike margins, sometimes aggressively, forcing traders to post more collateral or get liquidated. Analysts call this a kind of kill switch, flush leverage, reduce volatility, and protect fragile players who can't afford a runaway squeeze. But here's the key point you need tattooed on your brain. Margins can crush paper participation. They cannot create new silver. They don't add ounces to vaults. They don't restart a mine. They don't speed up a refinery. They only change who is allowed to stay in the paper game. So if the East is bidding for physical delivery, a paper margin death blow doesn't fix the shortage. It just changes the optics on screens. D. The Great Divorce. When arbitrage fails. The cleanest definition of this moment is simple. In a healthy market, price gaps invite traders to close them. In a broken market, price gaps become persistent because the mechanisms that close them are blocked, expensive, or politically constrained. That persistence is the divorce. Paper discovers a price, physical discovers a reality, and the gap between them becomes the signal. Okay, you say, if Shanghai is higher, why don't traders just buy in New York and sell in China? Because the trade is not a spreadsheet, it's a pipeline. To close a gap, you need three things: metal you can source, permission to move it, and time to deliver it. Right now, all three are under pressure. First, the metal. A lot of Western silver is paper exposure. Futures, unallocated accounts, synthetic claims, you can sell those all day. But when you demand bars, you hit queuing, fees, and tightness. In stressed markets, the thing that exists on paper doesn't automatically exist in a box. Second, permission. With China's licensing system ring-fencing supply, flows become political, not purely economic. Even if you can source metal elsewhere, routing it into the right channels is not guaranteed. The bridge is no longer open 24/7 for everyone. Third, time. Arbitrage works when delivery is fast enough to capture the spread. When lead times stretch, shipping bottlenecks appear, and counterparties get nervous, the spread becomes a risk premium. And a risk premium can sit there for weeks because it's paying you to accept uncertainty. So the Shanghai premium is not just a price difference, it's a delivery premium, a premium for certainty. And here's the psychological twist. Once buyers believe the gap is real, they stop waiting for it to close. They front-run it, they overorder, they secure allocation. They treat silver like a component, not a trade. That's why you hear the drain narrative. Metal pulled toward Shanghai and toward Mumbai, because the premium is a magnet and the policy friction is glue. Now, could the gap close? Yes, but notice what would have to happen. Either the West's paper price rises to meet physical reality, or the East's urgency fades, or policy friction loosens, or supply suddenly expands. That's a high bar. And that's why this gap has become the headline. Now add geopolitics, the part nobody wants to price until it's too late. De-dollarization is not a single event, it's behavior. And as 2026 opens, both India and China are treating strategic metals like heritage assets and industrial security inputs. That changes the psychology of stockpiles. It turns inventory into sovereignty. And there's another tell. In early January 2026, you had forced selling pressure from major index rebalancing, big commodity benchmarks adjusting weightings. In a normal market, that kind of paper selling cools the entire complex. It drags everything down together. But the physical market didn't obey. The premium stayed wide. The bid stayed urgent. That's what divorce looks like. Paper can wobble. Physical keeps bidding. So what does the 113 silver secret actually mean? It means you need to stop watching only the headline spot price and start watching the stress indicators. Because the real story is not silver is up. The real story is availability is becoming conditional. And when availability becomes conditional, the market stops being a chart. It becomes a supply chain, and supply chains do not care about your feelings. They care about allocation. Here's what you watch next, step by step. The Shanghai premium, does it stay above $10 or compress? Spreads and backwardation, does spot now stay more expensive than the future? Retail and wholesale premiums in your region, are dealers widening? Are back orders growing? Delivery language, listen for allocation, delays, extended lead times, margin announcements. They don't change physics, but they reveal stress. Vault chatter, any credible talk of tightness matters more than any influencer. Industrial headlines, solar, EV, grid, electronics, anything that increases must have demand. Policy headlines, licensing, customs friction, shipping constraints, the boring stuff that moves metal. And one mindset rule, if your entire understanding of silver fits in one number on a screen, you're the exit liquidity for someone who understands the plumbing. Let me end it like this. A $10, $13 premium is not a rounding error. It's not a curiosity. It's the market screaming that paper and physical are no longer synchronized. Wall Street can print 100 all day. Shanghai is paying what it takes to keep the lines running. That's the secret. And once you see it, you can't unsee it. If you want a part 2 where I track the delivery versus chart signals week by week, comment one word, delivery. And if you think paper will regain control and the gap will close soon, comment chart. $100 on a screen is the paper story. 110 plus in Shanghai is the delivery story. The $10, $13 spread is a stress gauge, factories paying up, arbitrage blocked by friction, and physical availability becoming conditional. So watch premiums, backwardation, lead times, and policy, because those move before the headline spot price does. If you're only tracking candles, you're late. If you're tracking delivery, you're early. Next phase usually arrives quietly. A sudden dealer out of stock, a widening local premium, a sharper margin hike, or a headline about export licensing. Stay calm, think in supply chains, and don't confuse volatility with resolution. This is education, not financial advice. But the message is clear. When the East pays $113 and the West prints $100, price discovery is migrating to whoever demands the metal, not the promise. See you in the next update.